Welcome to Lonsec TV, I'm Gordon Toy, and today we're looking beyond the traditional asset classes and delving into the world of alternatives. And joining me in the discussion is Sam Morris, Senior Analyst at Lonsec. Sam, alternatives might be considered by many investors to be quite a risky asset class, but what are exactly alternatives and how do they add value to investor portfolios?
Well, some investors and consultants consider alternatives to be anything other than equities and bonds, and we at Lonsec take a slightly narrower view, and we've got discrete property and infrastructure asset classes. We consider alternatives to be hedge funds, private equity, and commodity and currency funds.
And what have we seen in terms of ratings outcomes and ratings movements in this sector review?
Well, we've rated 33 actively managed hedge fund or private equity strategies as part of the review, and 8 ETFs, they're commodities and currency ETFs. And the ratings outcomes, we've had 6 downgrades and 1 upgrade. And the rating profile or distribution of the sector at the moment is what I'd call having a negative distribution skew, and that reflects the high number of investment grade funds and only 4 highly recommended funds. The key reason for that is that the performance of the sector has been pretty poor over the recent years, and also the fees are very high.
We've seen a pickup recently in investor appetite for alternatives products. What's been driving some of this demand recently?
Yeah, well, as I said, it certainly hasn't been the performance of the sector that's been driving interest in this space. It's really been investors looking at the valuations on the equity market and also on the bond market, with yields being at historic lows, and neither offering really a great risk-reward trade-off. And so investors are really looking for somewhere else to hide and park their money without taking particularly the equity market risk.
And speaking of performance, what have we seen in terms of the industry as a whole?
Well, the industry as a whole has been quite disappointing over the last 5 years, and alternatives and hedge funds have underperformed equities and bonds. And the reason for that, well, there's multiple reasons theorised for the sector disappointing. The industry itself may have got too big. Hedge funds, individual hedge funds may be too big. The macro environment is not seen as conducive to delivering alpha, and that's because quantitative easing has led to, and low interest rates have led to very low stock dispersion or security dispersion. And the other key reason is the high fees of the sector, which ultimately are taken away from net performance.
You mentioned in the sector review that fund of hedge funds have been particularly disappointing. What's been dragging down that performance?
Well, the key thing is the higher fee load. Fund of hedge funds, there's 2 management fees and often 2 performance fees, so that's weighing down on returns. They're also often overly diversified. This has actually led to the rise of and growth of a new subsector, which is the systematic risk premia, which is a subsector which looks to exploit, do hedge fund-like trades using behavioural anomalies in the market, and really focusing on those types of strategies, such as carry, such as value, such as momentum, and implementing those types of trades in a systematic approach.
And in contrast, we've seen managed futures actually performing quite well, and this is quite an interesting area as well. Can you tell us a bit about that?
Well, managed futures is probably one of the more interesting spaces in the alternatives area. We've got 4 funds which are really direct competitors against each other, and this is the alternatives universe as a whole is very heterogeneous, and there's not many areas where you've got direct competitors doing very similar things. They're all targeting various trend-following strategies as the bulk of their approach, and trend following is a really interesting concept, and it goes against fundamental investing and also the efficient market hypothesis. and it's really based on behavioural ideas. And the data of trend following is really strong over a long period of time, so it's really interesting. One of the key things that we note is that the backtest looks really good both in really strong equity bull markets and equity bear markets. And this ability to perform in an equity bear market is really quite a valuable feature, given that most overall client portfolios are very heavily dominated by equity market risk.
And macro funds as well looks like another interesting area of growth. So what have been some of the developments we've been seeing there?
Yeah, well, there's been extremely strong growth into macro funds based in the UK, particularly from the European market, with great inflows for a number of new strategies. There's been the rise of two new strategies over the last couple of years, which have both spun off from the very successful Standard Life GARS strategy and team, and their Invesco Perpetual have set up a new fund or a new business, and also Aviva Investors. We've also seen JP Morgan come out with a new macro strategy, which has been growing organically. So yeah, it's a really interesting space with a lot of growth potential in terms of assets.
And obviously 2016 has been dominated by geopolitical events, whether it's Brexit or the upcoming US presidential election. How have funds been performing in this general environment?
The results have been mixed, really. It's really been an interesting time with Brexit and Trump. We went on our alternatives review overseas in April, just before the Brexit vote, and one of the really interesting things was how interested and how focused the UK market was on Brexit. And then when we flew to America, it was seen as sort of an interesting but more a side issue in terms of the overall global economy. In terms of Trump, the markets are a bit perplexed about the potential impact that this could have, and in what would be the winners and the losers of this if he does manage to pull a rabbit out of the hat and succeed. It's seemingly unlikely at the moment, but I think the Mexican peso has become the dominant trade over the recent days, and I noticed in the latest, in the first debate with Hillary Clinton, when Hillary was starting to win, there was a big spike in the peso.
Well, Sam, thanks very much for sharing your insights with us. And to our viewers, thanks again for tuning in. As usual, for better investment outcomes, visit lonsec.com.au.